Joining us now is Apollo Global Management Chief Economist Torsten Slok. It's good to have you. Do you think the equity market is being complacent here about this risk?
Well, I think a very important issue here is the backdrop is still inflation is too high. The numbers we'll get on Wednesday, the consensus says inflation remains at 5%. The Fed's target is that inflation should come down to 2%. So with that backdrop, everything with the debt ceiling is, from a Fed perspective, a little bit of a near-term sideshow. But the bottom line still is that the Fed is going to keep rates elevated for quite some time to make sure that inflation comes down. And if this creates some issues, there is a plan at the Fed, at least for dealing in the short term with some of the problems that might be happening in financial markets. But at the end of the day, this is obviously a political problem.
So you just see it as sort of a bump in the road and not a change in the economic outlook if we, I don't know, default?
Well,
we even
obviously
say
that would be a complete disaster. So, but the issue here, of course, is for markets is what is it going to do to rates? There's a lot of debate about are rates going to go down as a result of it, or are rates going to go up?
That's what happened when we got downgraded in 2011.
Exactly. So that's what's so important about this. For the Fed, it's about we got to tighten financial conditions. We got to get inflation to come down, and in that process, a lot of things are happening. But this political problem here, of course, is also something that they need to deal with.
Powell last week said, don't expect the Fed to be able to save us in a situation like that. And I'm thinking more broadly about your own view. You kind of graduated from what was a benign outlook to maybe something a little more harsh, I would say, in the last month or two.
Absolutely.
Has the data last week, let's say, caused you to give that a second look or not?
No, it's sure that this takes a longer time. So what's really going on, as you talk about all the time, is the economy is slowing because the Fed is hiking rates. We're now adding on top of that tightening of bank credit conditions. So the question is, how long time does it take before tighter credit conditions begins to show up in the data? In the Fed's H8 data that comes out every Friday, things are still reasonably okay, but things are slowing down across the board. So the conclusion still is, it is coming, the slowdown is here, because that's what the Fed needs. If you ask the Fed, what is the goal with this? It is to slow down the economy, to slow down earnings. And that's really important to keep in mind when you think about asset allocation. The goal is to really get earnings to slow and to grow at a lot slower rate to ultimately get inflation to come down.
You mean average hourly earnings?
No,
or
I mean
earnings
for S&P 500.
S&P 500 earnings.
Because the idea from the Fed is to slow the economy down, to get inflation to come down. Inflation is just too high. So the starting point for a conversation about even the S&P outlook is all about inflation is just too elevated, and the Fed is going to do everything they can, even if it comes with a recession, to slow things down.
So is 220 too optimistic?
Well, it hasn't gone down. Last summer, it was 235, so it's really not much of a downward revision. More recently, we've actually seen an upward revision. Right. And the final issue on this, not to overcomplicate this discussion, but remember the housing market is now recovering, and housing makes up 40% of the CPI. So if housing now begins to recover and home prices begin to go up, we may have the problem that inflation is just more sticky, and therefore the Fed will have to crush demand even more in the economy to get inflation back to 2%.
So it sounds like you do not think they're done.
So I still think that they at least will keep rates elevated for a long time. But if housing begins to recover, they may not be done. So what's really important about this is that the goal for the Fed is to cool the economy down, to cool inflation down. And they have just not succeeded. With the inflation data on Wednesday, the consensus expects 5.5% on core inflation. That's way too high relative to their 2% target. And the market, equities included, also credit markets, should be looking much more carefully at, well, what is it that the Fed is trying to achieve? And the Fed is trying to achieve lower inflation, and they're just not succeeding quite yet.